715 on the downside and 750 on the upside.
Well, we'll be losing Robert very quickly because of a technical problem. Robert, can you just tell us whether you would change any of your targets, forecasts or expectations after what you have heard from the policy?
No, certainly my knee-jerk reaction is to say that's unlikely. No, I'm sticking with my 6.2% growth forecast for this year. I also have 8% for the following fiscal year. As we talked about, I'm certainly again not panicking to change my rate views. I really think all this boils down to whether the RBI really thinks this is a genuine inflation problem or just a supply-driven problem. Now, it seems to me that at least at the moment this is a supply-driven problem, and that's likely to remain the case for some time. And against that background, I can't see them doing anything particularly aggressive anytime soon. They may do something on CRR over the next few months, but all that's going to do is just take away a little bit of liquidity, which in any case the commercial banks were lending to the central bank via the reverse repo. I don't think it will have any meaningful impact. So, yeah, bottom line for me is that this doesn't really change anything in terms of key forecasts.
All right. Robert Prab on the spot, thank you very much for joining us. Well, a status quo policy is what the economist thinks it is, but let me ask the banker if he thinks it's status quo. Hasib Drabu, would you expect that after what they have heard in the policy and what the RBI threatens to do, its bark rather than its bite, do you think that there will be any more cuts in deposit rates or for that matter in lending rates?
For quite some time we have now seen that banking sector as a whole doesn't react to policy rates as such and with instantly or with a time lag. It is increasingly getting driven by the liquidity positions in the market. The demand and supply for credit is essentially getting determined in the credit markets. So at the moment I don't see the need to do either. So what one would really expect is status quo for the next quarter. But there are enough signals that should set the banks get a bit worried. One is the whole issue of credit growth itself. Second is the credit quality issue, especially the restructured portfolio. And third is, if you notice that the banking sector now has a fairly high investment to deposit ratio. Credit deposit ratios have come down. And that in a volatile environment like this would have an impact on bank bottom lines. The
person I really want to speak to is Hemant Mishra. Hemant, you've heard the complex of things. How much really does a loan cost go up? Need banks actually raise their lending loan rate to a real estate company because of this 0.6% increased provisioning?
I'm sorry, Lata, I don't think I can share exact numbers, but yes, if the provisioning increases, it needs to it will translate into a higher cost, but just to give the context around this particular move, central banks globally are worried about asset bubbles. And the RBI's case is not any different. In fact, the governor went on record only a couple of weeks ago expressing concern on the amount of money that's feeding into a couple of specific structures. A couple of specific sectors. So in many ways it was expected. Assuming the margin on the lending to that sector remains the same from a banking perspective, I would expect the cost of liquidity to that sector to go higher. It's difficult to put a number to that though.
Okay, the other question which I was asking Hasib, you as a banker should have a clearer idea of listening to everything that was done and the fact that provisioning has gone up for the biggest PSU bank as well as CRR would increase for all the savvy private and foreign banks. Given the complex of factors as well as the tone of the Reserve Bank, do you think no bank will have the guts to henceforth lower their deposit or their lending rate? Do you think they've heard the last of the deposit cuts for now, or the last of at least the lending rate cuts for now? Hemant?
Oh yeah, sorry, Lata, yeah. That's an interesting question. I would believe that given the change in monetary stance, this could well be the last of lending cuts. I'm less sure on deposit cuts for the reason that they've levied a CRR charge on borrowings through the CBLO window. And that again is very much what's happening globally. The FSA has been asking banks to not run massive liquidity mismatches. The way I read this particular measure from the Reserve Bank of India is they don't want banks to be too reliant on wholesale borrowings. And they want banks to be running books on a matched basis to the extent it's possible. Now, if retail deposits look lucrative vis-a-vis CBLO adjusted for CRR charges, I could still be there in the market at a rate which is better. So, I mean, you could see a divergence between where lending rates go vis-a-vis where borrowing vis-a-vis where deposit rates go. But I'm not expecting any of these rates to come down.
All right, Hemant Mishra, thank you very much. But let me leave you with some thoughts there's some observations which will definitely be music to the ears of bankers like you. The final rules on corporate bond repoability will be put on the website on November end. So starting November end, you can repo on corporate bonds. Rules on the RBI will start issuing rules on debentures under 1 year. That is basically CPs will start getting regulated by RBI rather than SEBI. That's well, just an administrative detail. CDS, credit default swaps of a very, very vanilla variety are likely to get introduced. The Reserve Bank has said that it will constitute a working group to go into what will be required and what rules will be needed. So something hopeful on that. Strips trading is expected to be launched very shortly. Very importantly, currency futures are likely to be introduced in Euro INR, Yen INR and Pound INR. So an expansion of the currency futures market is on the cards, and the RBI has given its first green signal to it. There are also fresh guidelines going to be issued on FX derivatives, commodity derivatives and watch this, freight derivatives. So a genuine expansion of market instruments in terms of derivatives, in terms of various kinds of currency futures and in terms of new instruments entirely new to the Indian market like credit default swaps and repoability of corporate bonds is very much lined up. So watch out, expansion of the fixed income market is very much there on the cards. Those are some positive signs given on market developments by the Reserve Bank. It's time I summarize for those of you who were not in on what the Reserve Bank has announced. It has not shifted any of the major lending rates, but that really is the only good news. On other aspects, the Reserve Bank has quite clearly moved all the special facilities introduced, like a special refinance facility for exporters that was available up to 50% of bank outstanding loans to exporters. That's been brought down to 15%. SLR has been restored to the 25% mark. Special repo facilities for lending to mutual funds, NBFCs have all been stopped. So basically anything special introduced in the post-Lehman period have been withdrawn. So the first phase of exit of monetary policy, special monetary policy instruments has begun. Extremely hawkish document as far as inflation observations are concerned. That becomes the prime fundamental responsibility of the Reserve Bank. It says that in as many words when it says the RBI is mindful that its fundamental commitment is to price stability. That's a very, very important statement in sharp contrast to what it said last time. Also, it has increased provisioning cover to 70%, bound to increase the cost for banks like SBI and for a whole host of other banks. I'm singling out SBI because it's top of mind recall, but that will mean costs go up. Real estate companies quite clearly are going to pay more for their loans. NBFCs better watch out their credit standards and ratings, because if they lose their credit rating even by a notch, banks will have to set aside additional capital for their loans, and therefore NBFC companies better watch out for their credit quality very, very sharply hereafter. They can't lend without let or hindrance. That's the crux of what the Reserve Bank has done. It has very neatly dodged the political pressure coming on rates, but it has introduced some kind of tightening through the back door into key sectors like real estate, like NBFCs. I would say a very wily Reserve Bank policy.